お待たせいたしました。
Thank you for waiting. It's time. Let us resume the session. We're going to start panel discussion 1. Let's have the panelists come up onto the stage. Let's welcome them with a big round of applause. So please be seated. I'm going to hand the mic over to the moderator, consultant at Visual Alpha, Ms. Scarlett Lee.
Thank you. Good morning, everyone, and welcome to the Global Asset Owner Panel. I'm Scarlett Lee, a project consultant on the Tokyo Emerging Manager Program. From our conversations with allocators across different regions and structures, one thing comes up again and again. Family offices tend to be some of the most natural and well-aligned partners for Japanese emerging managers. Family offices are not simply smaller versions of institutional investors. They operate with different incentives, more flexibility around ticket size, different risk appetites and time horizon, and often different governance frameworks. All of that shapes how allocation decisions are made, especially when it comes to emerging managers. We're very pleased today to be joined by a group of allocators with quite distinct perspectives. We have 3 family offices, Chartwell from Hong Kong, Khattar Holdings from Singapore, Lupoff Stevens from New York, alongside TIFF, a $10 billion US OCIO serving endowment clients under strict fiduciary duty. That allows us to take a look at both sides of the allocator landscape and see where views align and where they genuinely differ. I'll start by asking each of them to take a minute to introduce themselves and their mandates for Japan. Then we'll move into why Japan, why emerging managers, and how these allocation decisions are made in practice. Our hope is that today's discussion gives you a clearer view of how sophisticated, global-minded allocators think about decision-making, partnerships, and capital allocation. And with that, Daniel, please.
Hi, I'm Daniel Jim. I represent Chartwell Family Partners from Hong Kong. So we are a cluster of 6 rather old families in Hong Kong. We mostly promote advocacy, and then we're trying to make an impact with the investment that we do.
Hi, it's a pleasure to be here. I'm Leo. I represent a single family office based in Singapore. We run a multi-asset strategy across both public and private markets. The principal actually made his wealth from investing, so we approach all our investments through those lenses. A lot of our exposure is in the US and India, and in recent times, because of what's happening in the US, we are looking to diversify away from it.
Good afternoon, everybody. My name is Makishi, and I represent a New York City-based single-family office started by a former hedge fund manager, Peter Lupoff. My mandate is in impact investing, and I specifically diligence our early-stage venture deals. Our portfolio strategy is pretty split between equities, and we're also in fixed income, bonds, but we're also LPs in various hedge funds. And I diligence our venture deals mainly as passive LP investors into third-party fund managers and opportunistically into directs. My principal is also a partner at a multi-family office that has invested in a Japanese hedge fund that has done well. And likewise, for diversification purposes, we're always looking at different opportunities.
Hello, everyone. I'm Julia Zhan from TIFF Investment Management. We are a outsourced chief investment officer, OCIO business, based in the United States. We have an excellent board with CIOs from Harvard University, University of Virginia, University of Washington, Gates Foundation, MacArthur Foundation. We serve primarily US-based endowments and foundations. We also have family office clients. I am from the public equities team, but we invest across public equities, hedge funds, and private markets.
Thank you all. That's very helpful context. So let me start with a broader question. Why are emerging managers important to your portfolio, and how do they align with your broader investment objectives? So Daniel, during last year's panel discussion, you mentioned for Chartwell, it's about capital perseverance, diversification, and making that social impact. Kay and Leo, does that ring true with you? Okay, perhaps we start with you.
Sure. Yes, like I mentioned, my mandate is impact investing for early stage venture. And so emerging managers is part of our strategy because we feel like we can make that impact the more upstream we go. That said, we're also LPs in established hedge funds, quite large ones that everybody in this room would know. But again, the mandate of the family that I represent, and each family is very different amongst the family office community, cares about making that social impact, which is defined loosely as anything positively impacting people and planet. So if a fund manager or founder is self-proclaiming that their company or fund is doing something that is positively impacting people and planet, we'll take a look at that. And so for those reasons, for example, we did a EM, we invested in 2 EMs in early stage venture last year. One was in ag tech and food, and then another was more general. And so we're using that, again, we believe in the managers and also to diversify how we're making that impact. We believe food and ag is a good nexus of people and planet. We're helping to innovate in the food supply chain system. At the same time, food and agriculture is a big impact on climate. And so we feel like that for those reasons, it kind of hits at the nexus of impact. And then another generalist impact, which is an early stage emerging manager that invests in the top Ivy League school entrepreneurs across the US. And so that's another way we find to diversify how the family wants to make impact.
Leo, how about you?
Yeah, so so the family is very returns focused. So we care a lot about returns. And in our experience, and also the data has shown that emerging managers actually do outperform. In private markets, I think it's very obvious. A lot of fund ones do a lot better than fund 2s and 3s. So we actually do have a habit of backing a lot of fund ones, managers who have never done this before, or managers who have actually struck out from a larger institution. In public markets, we like smaller funds because they can concentrate on very niche strategies, very high conviction, smaller position, smaller portfolio, but very high conviction in all these positions. And this is the kind of things that resonate with us because we run our own public book too, and we run a very high conviction book, right? We have a very long-term perspective, but our book is very concentrated in US and India. So for us, the mandate is to look for managers who invest outside of these regions, and we try to look for managers which are smaller and have more niche strategies.
And Julia, I might bring you in here as well. So how does emerging manager allocation look different for smaller endowments compared with larger institutions?
Well, similar to Leo, for my portfolio, we look for the highest risk-adjusted returns. And I was at Dr. Ishida's presentation this morning, and he mentioned for FinCity to select managers, you look for novelty or innovation. Similar for us, we think emerging managers, they could be more innovative, and with innovation that comes with a competitive advantage that they bring to our portfolio. And for our portfolio, we run fund of funds, and so every client gets the same allocation to emerging managers, and they are a very significant part of our public equities book.
Got it. And then the next question is something we get asked quite often by Japanese emerging managers. When you are evaluating opportunities, do you apply minimum return or liquidity requirements? And do you approach managers with little or no track record differently? Julia, from an OCIO perspective, how do return and liquidity thresholds come into play in the context of emerging manager investments?
Right. We do not have hard requirements on track record or years of history, so on and so forth. However, we run several different kinds of fund of funds. One is a daily liquid mutual fund, 40 Act compliant in the United States, and for that we look for daily liquidity in managers. And so if any emerging manager, they are flexible in terms of negotiating terms with us and they would offer daily liquidity, that would be an advantage for them to work with us. But otherwise, we also are flexible on liquidity terms for our flagship funds. So annual liquidity or with a 3-year lock, it could work for us as well.
And I suspect this may be one area where family offices and institutional investors take slightly different views. So Daniel, how do you think about this at Chartwell from a portfolio construction standpoint? Is there more room for judgments from a family office perspective?
You're talking about liquidity and then the other requirements.
The minimum requirements,
I think,
or track record.
I think in line with what Leo is saying, right? By definition, if you're going into an emerging manager, you are actually looking for them being very niche. So by definition, the liquidity requirement, and then also even the size, has to be more flexible. Sometimes I think it is not necessarily you have to do a totally different strategy. Because honestly, it is not easy to innovate, especially if you're doing the public markets. But then don't underestimate the edge that you can get by doing actually a very liquid strategy, but being small and nimble. Especially nowadays in the hedge fund space, as we all know, is very much dominated by the multi-manager platforms. But we also know, basically, they only operate in a certain space, especially if you're looking into the equity markets. You know very well there are names that they won't touch because it won't move a needle for any one of them. And that's your edge, that's your niche, right? So I think sometimes don't force yourself too hard to say, oh, I have to come up with something very different. It is just sometimes going back to the space that everybody is in. It may look crowded, but just exactly because you can make a difference. And then that you can actually, I will even say, take advantage of the big boys when they are probably on the other side of the trade.
What about ticket size? Do you have a minimum ticket size for these managers? Because when we talk to some of the larger platforms, they usually say, oh, our minimum ticket size is 10 million US, for example, or even 50 if it's public equities, because their platform is so big and they have to justify the time and the work and the resources being put into studying one manager before making that investment. So is that where family office can be a bit more flexible?
Oh, certainly. I think it's related to, if you're running a niche strategy, by definition, your capacity is quite limited, right? So in the sense that I won't expect you to ask for a very high minimum ticket. Typical families that we worked with, we go with whatever minimum you ask for, and then we build it up from there. Because you need some time to gain the confidence, and then you need also some time to get to know each other. Because we look at them as a business partner of ours. If I make an allocation, I would like to stay there forever, right? If not, then, I will be very busy every year trying to recycle my portfolio. So that's probably the way how we look at it.
And Kay, you're the VC guru in the room. So from a private market standpoint, how do you think about return and liquidity trade-offs at that stage?
Sure. Well, that's very kind of you to say I'm a guru. I wouldn't consider myself a guru. So as you all know, VC is a long-term game, right? And so we're not expecting the lockups, the time horizon. We're mixing that in our overall portfolio mix. And so VC allocation is a small percentage of our total allocation. And so the way we look at it is that we're LPs, as I mentioned before, in various hedge funds, which we see as offering us the ballast and the liquidity to be more intentional with some of our longer term horizon investments like VC or various individual companies that we're investing in. And so with that, right, we are still looking for the return target profile for that asset class. Because we're locking up our capital for a longer term horizon, we are looking for the relative returns for the time that our capital is locked up. And then, we're also in various private equity funds. We have investments in private credit. And so the way we look at it is not just a specific asset class like VC in itself, but a total balance of our portfolio and ensuring, I think Daniel mentioned it before too, not just preservation, but, we're not super aggressive in growth. And so we can, still looking for target returns, but be a little bit more flexible in our expectations if the allocation is being invested into impact-driven causes as well. That's not to say that we're foregoing returns. Obviously, the family office was run by an individual that made wealth through hedge funds, through investments and smart investments. And so we are still looking for returns. But our philosophy is that we can make impact investments into good managers doing good things in the world and make a return as well. That's sort of how we look at venture and returns and liquidity, more so holistically as a portfolio and sort of the blended return versus just that pure asset class.
Got it. What about you, Leo? How do you think about that themes at your family office?
So venture is interesting for us because we actually invest a lot in venture, and we do a lot of early stage. We invest from early stage all the way to growth, to secondaries. The principal, because he started, he got his wealth from investing, and a lot of it is through investing in early stage venture. So until today, we still have a very long history. And the culture is to do a lot of directs, both through managers and investing in managers and doing co-investments with managers. So I'd say that for emerging managers who are in the venture space, it's very, very different because for first-time funds, where if you're in early stage venture versus a first-time fund in growth ventures, the skill set is extremely different. Like the deal flow is super important for you if you're trying to start the fund in the growth stage. And for the early stage investors, we actually do look out for managers who have a very non-consensus type of investing mind, because we think that's extremely important for early stage venture. Someone who can really look at businesses outside of the box. In terms of liquidity constraints, we actually do like capacity constraint managers because, like Daniel said, these are the kind of managers who can execute on very niche strategies. Right? Once you get to a certain size, you tend to lose that ability to deliver the alpha from these kind of strategies. So for a lot of our managers, we do not encourage them to increase their size too quickly. We encourage them to grow into it through performance.
It's very encouraging to hear that our allocators don't really only just look at the track records. So perhaps we can build on that by talking about convictions. So when you first meet an emerging managers, what makes you think this is someone that we want to grow with over the next 3 to 5 years? And what are some of the more common mistakes that emerging managers make when pitching to asset owners? So Leo, you meet with hundreds of managers around the world every year. What's your take on this question?
So we think about it in terms of if you're an emerging manager, not only are you a fund manager, you're also a founder, right? So this is your startup, and you need to have that hustle. You need to be very focused on what you're trying to achieve. So we've met some first-time managers who care a lot about their strategy, care a lot about how they're going to invest, but they don't give enough thought about the processes. And for us, it's very important to have that institutional intent from day one, right? You need to have that transparency, you need to have compliance. All of this needs to be settled, okay? We care about that as much as we care about your strategy. And I think one of the most common mistakes I've seen from emerging managers is trying to oversell themselves and trying to grow the AUM too quickly, targeting institutions from day one. I mean, you are a first-time fund. I do not know how institutions operate that well, but I think if they're going to write a 20 million check, there are some checks that they need to pass before you get there. So be focused on the process, care a lot about your company, which is the management company that you're starting. You are a founder, right? And treat it that way.
So show your drive and have all the infrastructure in place. Daniel, how does that compare from a multifamily office perspective?
Actually, I echo what Leo had said. I think, one thing which is always a challenge I can understand for an emerging manager is that, just like what Leo is saying, you're actually running a startup, right? And so from what used to be that you are the star portfolio manager wherever you were before starting it, now you're suddenly sitting here, investing is actually become the second priority. Your first priority is to keep this business going. The challenge a lot of the times is that not that many of these managers like to run the business. But it's very early, you can't afford to have somebody that are very good at running a business to come in as a partner. And even if there's such a person, they may not want to join. So I think that's really a challenge I see for most emerging managers, is that it's getting to a point that you probably really need quite a good war chest to keep you there for a few years for you to sell through. I mean, like what Leo is saying, for most of the people, it's very difficult for them to write you a ticket, the first time they met you. They're just going to track you, they're just going to see you delivering what you're actually telling them to build up the trust. But by the time that they're ready to write a ticket, you may not be in business anymore because you're running out of cash flows. So I think that's always the challenge. I don't really have an answer to that, to be very honest with you, and I think that's why you see a lot of people now rather just join the platform, because if you just want to run money, a platform is probably an easier place for you to, number one, satisfy, what you'd really like to do, and number two, obviously, you still make a good living out of it.
So have that grit and just keep the communication channel open with the allocator. What about the mistakes that you've seen from these emerging managers who pitch to you, other than just have that initial meeting and then lose contact? What are other mistakes that you've seen? Can you give us some more examples, Daniel?
A little bit related to what I was just saying, I think, remember, you are there trying to look for a partner. But then also you are there to deliver, what you're promising them, meaning some sort of return guidance and a certain risk level. They don't have any obligation to make sure that you are successful. So, you have to find the right balance and not being too keen. Sometimes manager comes in is as if, well, I've been talking to you already for the third time, why don't you write me a ticket? And sometimes, unfortunately, that the track record is just not there again, or maybe you are just doing things slightly different from what you were telling me before. I think one example I can quote, it's especially for the last 2 years, you see a lot of managers doing very well. So imagine a fund just launched a year ago or 2 years ago, And then suddenly they make like 40%, 50%, 60% a year. And then, so they're very keen. They say, oh, Daniel, do you think now that you guys can write me a ticket? But then I was asking the question, but when you started, you were telling me you're guiding me 10 to 15 a year. So what happened in the last 2 years? How do you explain the big difference of your return? I mean, a lot of people thought that losing money is a bad thing. But I can also tell you, if you make too much money, or it is like so different from what you were guiding me, you know, I can't just doubt, you know, whether you were taking the same risk level that you were actually telling me. So I think that has to be quite careful when you communicate that. Just don't try to be too eager. The more eager you are, they say, oh, when can we meet again? You know, let me tell you how we make all this money. The more you're doing it, that actually you're pushing away somebody. You know, let the numbers do the talking. And then just be very consistent, deliver what it sets on the tin. And then every now and then, just make sure that they're aware of the performances. And then one day, you know, they will come back and knock at your door. Yeah, it's a long wait sometimes. You know, I've seen people tracking a manager for 10 years before they allocate. But imagine if the manager is still there after 10 years, chances are that when they want to allocate, the manager probably closed already, as in not taking new money, right? So that's always, and allocators are very aware of that. So that's always the balance that one has to strive.
Thank you. Okay, when you meet VC funds, what makes you click, and what's a red flag immediately there? Can you share a bit more about when you meet VC funds, what do you look at?
Sure. I guess to add something a little bit different perspective, I'm a former operator. And so similarly, in terms of, is this somebody that I want to partner with as an LP investor, but also as a founder and operator, is this a manager that I would want to partner with 5, 10 years to the duration of the company, right? So looking at it from that perspective as well, I think is really important. And really, how VCs can add value to early stage companies is by helping with sales and business development, right? I mean, the startup should be coming with the product, that's the IP that you know, has basically birthed the startup to begin with, so that the team should have that, right, as the core and not outsource that. But what they can outsource, or what they can, you know, ask for help with is commercialization and business development. And so when I look at VC managers, I'm looking at their network, I'm looking at how proactive they are they reaching out, are they the type of person that a founder and operator would want on their team to sell their company, right? So they're not just selling me on their fund, but they're also going to be selling their portfolio companies to other VC managers, to other potential customers as well. So I'm looking at, can they be a good representation of their portfolio company and truly add value? I think, you know, it's not so much a red flag, but you know, I get the same picture all the time, right? So we actually add value, we have a great network, okay, great. But digging into that is, you know, can you show me tangible results or case studies where you actually added value to your portfolio company? Were you out there as the sales force, as a true partner to your founders? You know, were you able to get clients? What does your network look like? How active are you as a manager? Not just going around raising money, but actually kind of being part of the team to your portfolio companies. So those are all things that I personally look at, not just from the LP side, but looking at it from the perspective as a former operator myself, right? Is this somebody that I would want representing my startup and being able to really be a true partner and help my startup grow, especially in the early days, because you just have an idea, right? It's a very nascent stage. And so you need as much help in the beginning as possible to get the early customers, to get early conviction from the public, from, you know, your industry, to be able to kind of help get it to the next stage. And also, too, again, do you have a VC network as well to sell? And, you know, VC is kind of like a markup game, right? You need to constantly, once you start raising money, there's a couple of different paths that you want to take, but in terms of higher valuations, right, can you sell it to other fund managers as well? So I think those are key things that I personally look at.
And Julia, given that many of the managers in your portfolio began as emerging managers, you've seen this play out over time. And where do emerging managers still tend to outperform our larger platforms, and where do more established firms still hold a clear advantage?
I think Daniel and Leo both mentioned they like niche strategies. I think when an emerging manager is in the niche market, a newer part of the market where they have a differentiated process, it tends to be capacity constrained. Or, for instance, we know in Japan these days in the equity markets, activism is a very popular theme. And many activist funds focus on microcap or small cap, mid-cap companies, where if you run a $10 billion fund, it will be hard to deploy. And here is where perhaps some lower AUM emergent managers would have an advantage. On the other hand, I also work with a lot of systematic or quantitative investment managers, and we know that machine learning and AI, artificial intelligence, are emerging tools for many systematic managers. Here, you need a huge infrastructure and big investments in CapEx in order to build the systems you need to run the strategy. And perhaps here is where existing large incumbents may still have an advantage versus smaller emerging managers.
I think that nicely captures the balance between scale, conviction, and discipline. So I want to end with one final question for all of you. Could you each share an example of an emerging manager investment that started small, but went to become genuinely transformational to your portfolio, and perhaps why it worked? Okay, maybe we can start with you.
Sure. Again, early stage VC is a long-term game, and we recently made our allocation, so it's still too early to say whether it's a financial success or not. But a couple of the key factors, yes, it was an emerging manager, yes, it was Fund 1. At the same time, this manager, she had a strong track record at a tier 1 financial institution, so that was a green flag for us. Second green flag for us was that she was a subsidiary fund of a larger institution that had over $1 billion AUM and had over a 10-year track record. And so she was able to outsource a lot of the back office type of legality and fund structure set up and really focus on really fundraising and investing in the managers and adding value. So we saw that as her time was more allocated, we were giving her the dollars, not back office staff dollars, right? A lot of that was sort of outsourced. And the success there, I think, was she was able to close her fund, and now she's raising a fund 2, and her portfolio seems to be doing well. So again, still too early to tell whether in generally it's a success or not, but again, we're looking at that as being a partner, and I think there's some wins there already.
Daniel.
Yeah, for me, the one manager that I made, during my career, the biggest allocation was made over a time of 15 years. When I first met the person, what he strikes me is that he's really passionate about what he's doing, and there was no mentioning at all of raising money. And then we kept in touch. He was based in London, and then every year, either he's in town or when I was traveling over there, we always meet up. And again, always talking about markets, stocks, never about fundraising. And over the years, I started to make allocation, and then again, never about, when will you top up and things. But then, you know what? It's just becoming very natural for me to allocate over the years. So yeah, that's my little story.
And how transformational has it been to your portfolio? Did it change the way you think about allocating to emerging managers?
Oh, certainly did. I mean, obviously this occurred at the beginning of my career as an allocator as well. Then of course I learned a lot, with this manager, and then, it's just natural that I will always use that as sort of a sample when I'm meeting similar manager. But unfortunately, it's that talents like that are difficult to find. It's just, unfortunately, I never managed to repeat anything like that after. And then it was just basically luck in a certain way when I first met him. But again, you know, I think going back to the point that I was trying to make earlier, you have to be in this game for the long haul, right? This is not a quick fix. This is not like, oh, I strike gold, you know, good years, and then I get the money and I run. Nowadays, allocators can see through you. It's not as easy as before. It's like, oh, some cheap beta to get, and you know, let's do the trade.
So consistency is the key. What about you, Leo?
Okay, so
So a success story, why it's transformational to your portfolio?
okay, transformational is a huge word. So let's just say it was very beneficial to our bottom line.
Sure.
So there is a very small VC, first-time VC that we backed. It was really small because they only raised, I think, around 16 million. One of the reasons why is I think they did not check a lot of boxes for a lot of investors because they were investing in Southeast Asia and they were investing in the US, right? Which I think a lot of investors were like, what are you? Are you a Southeast Asian fund? Are you a US VC fund? You know, get out my door. But for us, we did diligence on them and we really liked their network. And we believed that their deal sourcing funnel was really strong, so we backed them. One interesting thing that emerged from that was that in early 2023, they were doing diligence on another company in the AI space. And when they flew into town, we had a meeting with them. And one of the good things about emerging managers of this size is that they can spend a lot of time with LPs, talking to us about what they've done, talking to us about the kind of meetings they've had. They can spend like 3 hours with us and it's not a problem. So we like that. So they actually highlighted to us that in the US, there was a huge shortage of GPUs. So this kind of connected with us because we were doing a lot of diligence on a public book on NVIDIA at that time. And it really helped us triangulate and that, you know, we started a big position in NVIDIA and, you know, obviously that has done really well. I wouldn't say entirely due to this manager, but he really fed us information that was not publicly available information. In fact, I think we spoke to him in like March or April, and only in August or September was there news in the public that, you know, there was a GPU shortage, which caused like the stock price to go up. So this is an example of how these small niche managers with insights and with good deal flow can provide value.
Thank you. And Julia?
Right. So at TIFF, we like specialists. So I'll give an example of a sector specialist that I think helped transform our portfolio. It's called Strategy Capital. It's a public equities investor in global technology sector based in San Francisco. The CIO of the firm, Dr. Hamilton Helmer, he used to be a Stanford University Graduate School of Business professor, and he has written a book called 7 Powers that explains his investment philosophy. One of my colleagues read the book and then discovered, oh, this professor actually runs an investment management company as well, and that's how we discovered this manager and invested. And we like it because it has a proprietary investment philosophy and process. And Professor Hamilton Helmer also has connections in Silicon Valley and introduced us to many founders in Silicon Valley and CEOs of big publicly listed companies. So we think he also has a network advantage. And bringing it back to Japan, we also like country specialists. So we think it's very difficult for, say, a 40-year-old hedge fund manager sitting in the office in New York or London to invest well in Japan, who doesn't even speak Japanese. How can this person get a meeting with a 65-year-old CEO of a Japanese company and tell the CEO what to do, right? And so we are looking for country specialists in Japan, and I want to give a shout out to the CIO of Komfora, who was presenting earlier this morning, Takinaka-san. I think managers, emerging managers like him, who understands the unique culture of a country like Japan and the corporate culture, the product and service differentiation, so on and so forth. That's very important for any allocator. And I think it's emerging managers like him who will be transformative to global allocators' portfolios in the future.
Thank you. I think that's a very encouraging note to all the Japanese emerging managers in the room today, and the most fitting point on which to conclude the panel today. Thank you to all our panelists for open and thoughtful discussion. Please join me in giving them a round of applause.
Moderator.
So our panelists will be joining the lunch networking session at 12:25, and I encourage you to continue the conversation there. On behalf of Visual Alpha, FinCity Tokyo, and the Tokyo Metropolitan Government, thank you for joining us today.
Moderator, 登壇者の皆様。
To the moderator and all the panelists, thank you very much for your contribution. We'd like to express appreciation in the usual way. Thank you.